Hi everyone, I am Dr. Soundararaj. I am very happy to interact with you all through this video. In this video, I am going to detail a problem and its related solution from cost volume profit analysis. This problem is basically related with the determination of profitable sales mix for a business enterprise. These are all a few details related to my career. After you watch the full video, if you find the video beneficial to you, give a like to the video and do subscribe my channel so that you will get the notifications of my future videos. Let's get into the problem. The management of B Company Limited are considering the sales budget for the next budget period. You are required to present to the management a statement showing 1. The marginal cost of each product, and 2. To recommend which of the following sales mixes should be adopted. Regarding the mixes, they have given us 4 choices. Choice number 1, 1800 units of product X. Choice 2, 1200 units of product Y. Choice 3, 1200 units of product X and 400 units of product Y. Then the fourth choice is 900 units of X and 600 units of Y. The chief accountant has ascertained the following information. What is that? With regard to product X and Y, they have given us a few details like direct material 10 rupees per unit of product X, 12.5 rupees per unit of product Y. Selling price is 30 rupees per unit of X, 50 rupees per unit of Y. Direct labor is 25 paise per hour and it comes to 20 hours for every unit of X. Therefore, 20 hours into 25 paise, it comes to 5 rupees per unit of product X. Whereas it comes to 30 hours for every unit of product Y, therefore 30 into 25 paise, it comes to 7.5 rupees per unit of product Y. Regarding variable overheads, it is 100% of labor. Therefore, it is going to be 5 rupees for X, then 7.5 rupees for product Y. Fixed overheads in total 10,000 rupees. So, these are all the information presented in the problem. So, we have to find out with the given information, what is the contribution per unit of product X and Y. Followed by, we will prepare a statement which shows the contribution and its related profit for each of these 4 choices and eventually decide which particular choice or alternative sales mix is profitable for the business enterprise. This is what we are going to do. So let's start with the preparation of a statement showing contribution margin per unit of product X and per unit of product Y as well. Now selling price for X it is 30 rupees per unit, for Y it is 50 rupees. Then regarding variable cost, there are 3 elements of variable cost given in the problem. One is direct material, other one is direct labor and the third one is variable overhead. Direct material for X it's given in the problem as 10 rupees per unit, for Y it is 12.5 rupees per unit. Direct labor, as I said, 20 hours into 25 paise, here 30 hours into 25 paise, and that is what they have done. It comes to 5 rupees for product X, then 7.5 for product Y. Then variable overhead is 100% of direct labor. So you can copy the same amount of labor for X and Y as well. So 5 rupees is variable overhead for X, 7.5 rupees is a variable overhead for product Y. So the total variable cost for product X comes to 20 rupees, for product Y it comes to 27.5. So from selling price 30, if you subtract the variable cost 20, you get 10 rupees as contribution margin per unit of product X, whereas here it comes to 22.5 is the contribution margin per unit of Y. Now let's calculate the profitability statement for each of the alternate choices of sales mix presented in the problem. Mix 1 is 1800 units of X, mix 2 is 1200 units of Y, mix 3 is 1200 units of X and 400 units of Y, mix 4 is 900 units of X and 600 units of Y. Now let's calculate the contribution and the profit for each of the choices. Contribution 1800 units of X into its contribution per unit 10 rupees. So the total contribution comes to 18,000. From 18,000, if you subtract the fixed cost, it comes to 10,000 rupees. That's given in the problem. See here. Now the profit through the first sales mix is 8,000 rupees. And regarding the mix number 2, 1200 units of Y into the contribution margin per unit of Y 22.5, which we calculated as per the previous statement, it comes to 27,000 rupees of contribution minus fixed cost 10,000. So the profit is what? 17,000 rupees the company could generate through sales mix number 2. Then mix number 3, 1200 units of X, 400 units of Y. So 1200 into the contribution margin per unit of X 10 rupees is equal to 12,000 rupees. Then 400 units of Y into contribution margin per unit of Y 22.5, it comes to 9,000 rupees. So the total contribution through sales mix 3 is 21,000 rupees. If you subtract the fixed cost 10,000 rupees, you get the balance of 11,000 as what? Profit through sales mix number 3. Now sales mix number 4, X 900 units of X, 600 units of Y. So 900 into 10 rupees, the contribution margin per unit of X, it gives us 9,000 rupees. Then next one, 600 units of Y into 22.5, which is the contribution margin per unit of Y, it gives us 13,500 rupees. Therefore, the total contribution for sales mix number 4 comes to 22,500. If you subtract 10,000 rupees fixed cost, you get the profit of 12,500. So now if you look at the profits of all these 4 sales mixes, you find sales mix number 2 that gives us the higher profit and higher contribution as well. Therefore, you recommend to the management that sales mix number 2 is more profitable than other mixes because of its higher contribution and higher profit than that of other sales mixes suggested in the problem. Thanks for watching this video. I hope you have understood my explanation regarding this concept of determination of profitable sales mix for a business. I'll meet you in another video. Bye for now, everyone.